Welcome to the Wall Street Geek, where I want to wish you a happy new year and the opportunity to become a happy new geek by becoming better informed about important money matters. Looking back at the holiday shopping season, like me, you probably shopped at different types of stores depending on what you were looking for. Like, for example, if I need a business shirt, I may go to Thomas Pink, but if I need a white t-shirt, I like Hanes. Luckily, a variety of markets exist to provide us with what we need. The same thing goes for borrowing and lending. Whether you need to raise capital or protect what you own, you can go to one of several types of financial markets, which leads us to today's topic. Today's topic is how to use the global financial markets to your benefit, in particular as a business owner. Without an organized system of financial markets, people who need money would have a tougher time finding people who have money. For example, say that you have a lemonade stand, which coincidentally is one of my most favorite computer games, and you want to grow it. And waiting until you sell enough cups of lemonade before reinvesting in the business is making you lose market share to competitors. Well, you can go to an investment bank like Morgan Stanley and work with them to make an initial public offering if you plan to solicit money from the public, or a private offering if you want to solicit money from private investors. In both cases, in this example, we're talking about an equity offering, which allows investors to buy shares or partial ownership of your stand. Once the equity offering has been made and once you receive capital from your investors in exchange for partial ownership of your lemonade stand, you'll be able to buy more things for your business to help it grow, like a better stand or even better lemons. If you waited until you had the revenue to expand, it may have taken much longer than raising money through the equity markets. But the flip side is now you have to answer to investors who want their shares to grow in value. Because if your business does well, then your shares increase in value, making your shareholders very happy. Raising capital is just one of 3 reasons why a business owner may use the global system of financial markets. And the most common means of raising capital in the financial markets is with an equity offering like stocks. Now, a stock is a piece of ownership in the company that issued the stock to raise capital. When the company profits and maintains its positive future prospects, then the share owners profit. And when the company folds, like go bankrupt, well, shareholders could lose their investments. Now, other corporate action events besides bankruptcies may affect shareholders. I'll cover corporate actions in a future video. There are different types of stocks as well, such as common stocks and preferred, which have additional rights and benefits over common stock. In particular, in the event of bankruptcies, it's like having a green Amex card versus having the additional benefits that come with a platinum Amex card. Now, besides stocks, another way for a business to raise capital is with bonds. The market where capital is raised with bonds is the bond market, also known as the fixed income market. A bond is like an IOU. An investor agrees to lend money to a company or municipality that issues the bond at a predetermined interest rate. In return, the investor receives a guaranteed fixed stream of interest income for the lifetime of the bond. Once the bond matures, the bondholder receives back his or her original investment. For example, if you need to borrow $100 from a friend until you got paid, if you write an IOU and agree to pay an additional $5 regularly for borrowing the money, that IOU is a bond. And once you got paid, you then give your friend back the $100 that they lent you. This is why ratings are so important. So if a company or municipality has a high rating, that implies that the company or municipality is in a good position to pay its debts back to you. A low rating means that company or entity is financially risky and you may not get your investment back. In return for that risk for lending money to an entity with a low rating, you as an investor usually receive interest payments from that entity at a much higher rate of interest. You'd feel more comfortable lending money to someone with a high credit rating versus your cousin Jim Bob, who probably has a low one. So you probably charge cousin Jim Bob higher interest payments just in case he doesn't end up paying you back. Besides bonds and common or preferred stocks, there are other vehicles for raising funds, like through investment companies that pool together money from multiple investors. Common investment company products include mutual funds and investment trusts like REITs or real estate investment trusts, which provide investors with a way to own real estate without owning physical property, which can be less liquid or harder to sell off. Commodities are another way to raise money. You could trade money for livestock, for fuel, for food like coffee, and also for precious metals like gold and silver. Raising capital is the #1 reason why folks believe that the financial markets exist. But do you also realize that you could use the markets to manage risk? Derivatives are the most common way to use the markets to manage risk. It's a way to hedge against price changes or changes in supply and demand. With a derivative, you can create a contract to buy or sell something at a specific price in the future. That something can be almost anything. It could be a stock, it could be a commodity, and it could even be an interest rate or currency. For example, say that you go to an electronics store and put your name down on a waiting list for the next iPad release. You know that it'll sell out immediately, so you slip the manager $50 and ask him to put an iPad to the side for you for a guaranteed price of $400. In other words, you paid $50 for the right to buy or not buy an iPad at $400 in the future. That's a call option, which is a type of derivative. We could even take this example further. Say that you and the manager wrote a contract between you saying that you would definitely buy an iPad for $400 in the future. That's a forward contract, which is another type of derivative. Other derivatives include futures, swaps, and structured products. Another way to hedge against risk is with insurance. You pay a premium, which is a type of fee on a regular basis, for the right to receive a predetermined cash payout if the event that you want to protect yourself against occurs. You should already be pretty familiar with insurance, especially if you own a house or a car, or if you have something else that's valuable that you want to protect. Even someone's life may be insured, and most importantly, key employees and head of households. A third reason why you may leverage the financial markets is for international trade. It's a way to facilitate the selling of goods and services across international boundaries where the currencies are different. If someone from Italy, for example, tried to sell someone in the US a genuine Armani shirt for 1,000 euros, how many dollars is that? Is that 1,000? Is it 10,000? Establishing a value for currency exchange is done in the foreign exchange market, or Forex market. It dictates the value of your currency in a market that uses a different currency. This is also known as the exchange rate. The exchange rate is based on the supply and demand of the currencies in question. It's a highly leveraged, dynamic, 24-hour market where money is made by being able to be on the right side of a trade when a change in supply or demand for a currency that you're trading occurs. Luckily, there's a standardized market for exchanging currencies. Otherwise, the Armani shirt seller may fleece you, or you'll go through planes, trains, and automobiles to get your hands on euros. Or you may not be able to buy or sell across international boundaries at all and miss out. The great part about all these different sides of the world system of financial markets as a business owner is that they all work together to help you raise money, to offer protection against the unknown, and to increase the number of markets that you can offer goods and services to. For example, you can buy property with money raised in the equity or bond markets and buy insurance to protect that property against unexpected events like fire. Even before you buy the property, you can enter into a forward contract with the seller to ensure that property prices don't increase suddenly before you make your purchase. Or if you own a lemonade stand and it gets very popular and you're concerned about the shortage of lemons at the beginning of the summer, you can enter into a futures contract to buy 1,000 lemons for $1,000 before the price gets driven up by lack of supply. In the news, we hear about the negative stories about the markets like Black Monday, Black Tuesday, Lehman, Enron, Greed is Good, Boiler Room. But there are positive sides to the market, like enabling a promising biotech company to raise money and continue their attempt at curing cancer after it makes an equity offering. Speculation, scalping, creative financial engineering, and other quick and dirty money-making practices have hurt the market's stability and reputation. But nothing's more exciting than investing in a company with a sound business and watching it grow. Over time, as that aspect of the market is allowed to flourish, the world's financial market may become a more encouraging place to grow your money and protect yourself against the unexpected, and to do business with someone on the opposite side of the world. Thank you for watching. This is the Wall Street Geek, hoping that you live long and profit. Take care and Happy New Year. Bye.